Buyers today don't just look at top-line revenue, EBITDA, or growth curves. They dig deeper into how revenue is generated, its consistency, scalability, and strategic value. These factors can significantly influence whether a buyer pursues a deal and how they value the business. Recurring SaaS revenue is the most valuable type of revenue. It's followed by on-premise recurring revenue, then perpetual software licenses, and finally, one-time service revenue. Each step down the pyramid represents a decrease in valuation multiples. Disruptive technologies may command higher multiples, but the structure of revenue remains a key driver. Cloud-based deployment is more valuable than on-premise, even if current financials are similar. Cloud solutions scale better, reduce service burdens, and allow for centralized updates and support. Private cloud deployments offer a middle ground, enabling remote support while maintaining customer-specific environments. SaaS combined with cloud deployment is the most attractive model. It creates long-term contracted revenue streams that buyers view as annuities. These are highly valued because they offer predictable future cash flows. One-time deals, even large ones, don't offer future value to acquirers. Revenue from perpetual licenses is in the past. It can't be leveraged for future growth. Buyers prefer multi-year contracts with renewals, which provide ongoing revenue and customer engagement. There's a common misconception that follow-on revenue is the same as recurring revenue. If a customer buys add-ons or services without a contractual obligation, that's follow-on revenue. It's unpredictable and not valued highly. True recurring revenue is defined by contracts that tie continued access to ongoing payments. Service-heavy revenue can dilute the value of a software business. Custom implementations or managed services may bring in cash, but they increase support burdens and reduce margins. Buyers penalize companies with high variable support costs. Outsourcing support or converting services into high-margin maintenance contracts can help preserve software valuation. Churn is a critical metric. High churn signals deeper problems and erodes the value of recurring revenue. Buyers focus on churn's impact on revenue and customer lifetime value, not just customer counts. Even partial churn, such as downgrades or skipped renewals, undermines confidence. A churn rate above 10% is widely seen as a red flag. Geographic concentration in revenue can impact valuation. Revenue from small or saturated markets limits growth potential, while expansion into larger markets builds buyer confidence. Geographic diversity and stable currency exposure give buyers greater confidence in projecting future performance. When benchmarking our business, we need to compare ourselves to companies with similar deployment models and revenue mixes. A SaaS cloud-hosted company may be worth much more than an on-premise perpetual license business, even if other metrics are identical. Precedent transactions must be evaluated carefully. Lifetime value is calculated based on recurring revenue and churn. It helps buyers estimate how much cash they can expect from each customer over time. High recurring revenue and low churn lead to stronger valuations. Understanding the quality of our revenue isn't just about preparing for M&A. It's a guide for building long-term value in the business.